Welcome to section 7, which we are calling the wide world of ETFs. ETF stands for Exchange Traded Funds, and they give you the best of both worlds. They combine the best elements of stocks as well as mutual funds, and you're going to find ETFs also a very good starting point if you're a beginner to financial markets. So let's take a look at these ETFs. ETFs have been around for the last 15 to 20 years. They have grown tremendously, and just in the US we have about 2 trillion in value, and if you look at global there's about 3 trillion in value. ETFs have been growing at about 25% a year for the last few years, and so they've become really popular. They are actually attracting money from mutual funds because of various negatives that mutual funds have. The big difference between ETFs and mutual funds is that ETFs track an index and they try to mimic the index composition, whereas mutual funds actually invest into stocks in that particular sector. Now, there's truly a wide world of ETFs. So we know we have S&P industry sectors. We have 10 industry sectors. We have major indices. So the SPX is a major index, the S&P 500 index. And you have the ETF SPY, which is also called the SPDR. Similarly, you have the financial ETF as well. So for financial services companies, that's the XLF. You also have the ability with ETFs to target any major country index around the world. So for example, FXI is the big ETF for China. Not only countries, you can now target major currencies. So FXE is the Euro ETF, and major commodities, for example, USO. So you're going to see so much flexibility with ETFs, and we're going to take a very detailed look at ETFs and how we can trade in ETFs, still get all the pluses of stocks as well as get all the pluses of mutual funds. Before we get into the actual ETF analysis, I just want to give some characteristics of ETFs. First of all, there's a massive array of ETFs tracking some index. So in fact, there are too many, if you ask me. There's almost 2,000 ETFs today. The big plus point is that they trade like stocks throughout the day. So you can get in and get out of ETFs all day, just like you would do with a stock. Many liquid ETFs, they also have options, and their options are also highly liquid. So this is a great advantage if you wanted to use options. ETF fees are much lower than mutual funds due to lower churn. Since ETFs track an index, they really don't need to go in and go out like mutual funds. Mutual funds have to do a lot of churn because they try to capture as much of the upside from various stocks within the mutual fund. So they have a lot of churn, whereas ETFs fees are much lower. Generally, this is to the advantage of the investor. Once you look at it over a multi-year period, even a small 1% or 0.5% starts making a big difference. Now, there are many types of ETFs, and we're going to look at leveraged ETFs and inverse ETFs in this section. Also, there are many asset managers. So what we want to do in the next lecture is take a deep dive into ETFs. It's a very fascinating instrument. The popularity and the flexibility and the breadth of investment possibilities is just infinite. So let's go take a look at a detailed study of these ETFs.